You think this is okay, what they're proposing?
Let me pull the lens out for a moment here. The banking industry has gone from blinking red lights to blinking yellow lights. The issues about big bank solvency and liquidity, I think, are mostly done. So now we can just talk about earnings, which earnings are an issue, but we're getting out of that bank crisis phase to more of one bank recession. The other, important point here is that how fast the regulators have turned this around. In less than 3 weeks, you had the House, you had the Senate, you have the White House. With a sketch out of a program, you put in place a liquidity backstop at the Fed for banks. You resolved the problem banks and sold them in terms of Silicon Valley and Signature, and you resolved Credit Suisse, which was a big systemic risk out there, and you've sketched out a plan. And the third important point is that there's no cost to the taxpayer. I mean, I hear it all over the place, the taxpayer this, the taxpayer that. Scott, do you pay insurance for auto?
Yeah, obviously.
Okay, and house?
It's required in the state.
And house and life?
Yes,
but do you pay insurance for bank deposit insurance?
I thought I'm supposed to be asking you the questions.
But do you pay insurance through the bank insurance fund to the FDIC?
No.
No, not at all. The banks are paying the price for this. So I'd say it's mostly as expected as far as what the White House came out with. More, you have the big bank regulation, like the 10 or so largest banks applied to the next dozen or so on down. More scrutiny of liquidity and higher interest rates. The one thing that I wasn't expecting is there's a carve out for community banks. For those 4,000 plus community banks, they don't have to pay for the cost of the recent bank failures. So that's less than 20% of the industry's insured deposits. So really who pays for that would be JP Morgan and Bank America, but I'm not sure anyone's shedding a tear for Jamie Dimon.
So number one, how can you sit there and declare that all of the banking issues are, for the most part, over? We don't know if they are. You got Fed people still coming out today saying, we need more rate hikes. Isn't that going to cause more problems within the credit system, more of a crunch? And then what comes on the backside of all of that are changes for the banks.
So let's group it, short term, medium term, and long term. Short term, the bank crisis issues, which had everyone unnerved, seems like it's probably over. Okay, the bank bond spreads have come in remarkably the last week or two. So the bond market's saying that banks are safer. This whole idea, can I get my money from the bank? I think people are getting the message the Fed is there to give you your money. So we go from the bank crisis discount should be eliminated. Then we go to the medium term, and you're right, there are issues out there. There's commercial real estate and office, and how will the credit be for that?
Well, those are big issues.
There's big issues, but they're not overnight issues. These are issues, they were around a month ago, and they're around now. I will grant you, there may be some contraction of credit, okay, because everyone's being a little bit more careful. If the banks have to build up their capital, they might be lending a little bit less or on, better terms for the banks.
Isn't the base case that credit tightens and that they lend less and that they may even raise the rates on their deposits, all of which are not good for bank earnings?
You know what? If we're debating bank earnings relative to bank solvency or bank liquidity, then that's a step up from where we were the last couple of weeks. But yes, there is pressure on bank earnings, funding costs. When first quarter earnings come around, there'll be questions about, what's going to happen to funding pressure, what's going to happen to bank buybacks, will they slow that a little bit, what's going to happen to loan growth overall. So there'll be some earnings issues, but I'd much rather be talking about earnings issues and what could happen in a recession as opposed to, bank failures.